Welcome to Talk Tickers, your go-to for breaking down the most important earnings calls.
Hey, everyone.
Today, we're doing a deep dive into American Eagle Outfitters, AEO, their Q2 Fiscal 2025 call, just wrapped up yesterday, September 3rd.
And it was pretty eye-opening. Some really strong numbers, some interesting strategic moves.
Yeah, the market definitely noticed. Big jump after hours.
Absolutely. So our mission, like always, is to cut through the noise, find those key nuggets for you.
Give you a clear picture of what's driving AEO and where they might be headed.
Exactly.
Yeah.
Not just what happened, but, why it matters going forward.
All right, let's get into it, because this really felt like a major rebound quarter for AEO. After some tougher times recently, the market reaction seemed really positive, right? Renewed confidence.
Totally. And you can see why when you look at the headline numbers. Let's maybe start there.
Yeah, let's do the snapshot first. What really jumped out?
Okay, so the big one was earnings per share. GAAP diluted EPS came in at $0.45.
45 cents. And consensus was what, like 20 cents?
Yeah, somewhere around 21 cents. So, they basically more than doubled it. A huge beat.
Wow. Okay, and revenue?
Revenue was $1.28 billion.
Right.
That also beat the consensus, which was around $1.24 billion.
Even though it was actually down slightly year over year, like 1%?
Exactly, down 1% year over year, but still beat expectations, which, hints at maybe better pricing or cost control.
Right, more profitable sales perhaps. What about comparable sales, comps?
Overall, comps were down 1%. It's pretty much flat, slight decline.
But the story's different for the two main brands.
That's the interesting part, yeah. Aerie comps were actually up 3%, a solid turnaround there.
Okay, so Aerie's showing strength.
But the American Eagle brand itself was down 3%. So that pulled the total down.
Got it. And profitability?
Margins improving. Gross margin was up 30 basis points compared to last year, hitting 38.9%.
Nice.
And operating income up 2% to $103 million. That gives them an operating margin of 8.0%. So holding up pretty well.
And maybe the biggest signal of confidence, they brought back their full year guidance?
Yes. That's huge. Remember, they pulled guidance back in May because things look uncertain with spring and summer demand.
Right. That Q1 call was rough.
It was. So reinstating guidance now, that says a lot about how they're feeling about the rest of the year. Huge confidence booster.
Definitely sends a message. But after pulling it just last quarter, does this swift return suggest maybe things are still a bit volatile, or are they genuinely on solid ground now?
That's the million-dollar question, isn't it?
Yeah.
I think the market took it as a strong positive. Okay, they fixed the Q1 issues. They see a clear path forward.
Suggests maybe better internal stability, better execution?
I think so, yeah.
Yeah, okay, so how did they pull this off? Let's rewind to Q1. They had issues with early spring stuff, weak demand for shorts, bottoms, had that inventory write-down, pulled guidance. How did they flip the script so fast?
Well, it sounds like they got really focused in Q2. They pushed hard on specific product initiatives, launched these big new marketing campaigns we'll talk about, and just tightened up operations. Better inventory management, crucially, trying to sell more at full price, fewer promotions.
Which helps the bottom line.
Exactly. And they said traffic was positive across brands and channels, and it actually built through the quarter and into August. So, momentum.
Okay, let's talk marketing then, because that felt like a massive part of the story. Sweeney, Travis Kelce. That's some serious star power.
Oh, it was huge. They called the Sweeney Great Jeans campaign iconic, said it affirmed AE as the American jeans brand.
Big claim. Did it deliver?
Apparently, yes.
Yes.
They talked about record-breaking new customer acquisition. Get this, across every single U.S. county.
Wow, every county.
That's what they said. 40 billion impressions, strong sell-throughs. Sweeney's signature jean apparently sold out in a week.
Okay, that's impressive. And then Travis Kelce.
Yeah, the True Colors collaboration. They said it was a year in the making. He was really involved as creative director.
Launched just recently, right? Late August, early September.
Right. And they said it drove tremendous engagement, higher traffic, brought in new customers. Apparently, it dominated the men's business over Labor Day.
So these weren't just like getting headlines. They actually drove sales and brought people in.
Seems so. The combined number they gave was over 700,000 new customers from these campaigns.
700,000. That's a lot of new eyeballs.
It is. And it led to record-breaking Labor Day sales. Their best ever, they said.
So the key question then becomes, can they keep these new customers? Turn that buzz into actual, loyal shoppers?
That's exactly their focus. They use the phrase, buzz into business. Both campaigns are ongoing, too. There's a second Kelce drop coming for the NFL season. More Sweeney stuff planned for the back half.
So they're trying to build on it. Makes sense.
Yeah, convert that initial splash into something lasting, especially for core categories like jeans.
Okay, so with all that happening, let's look at the brands again. Aerie was up 3%. What works so well there?
Right, Aerie hit record Q2 revenue. Was really strong demand in intimates. So that's about a third of Aerie's business, a big focus area.
Okay.
Also soft dressing, sleepwear, and their leggings. Offline activewear line did well. They mentioned new fits, fabrics, a Parisian romance capsule in intimates that resonated.
Sounds like they've got momentum in their key categories. And American Eagle, still down 3%, but any bright spots?
Yeah, even though comps were down overall, they said demand improved through the quarter. Women's jeans and tops were strong. Dresses did well. They mentioned the Sun Chasers collection.
Okay.
And for men's, graphics, knit tops, and jeans were actually positive in August. So maybe turning a corner there too.
But one area was tough across the board.
Shorts. Yeah, they specifically called out shorts as the most challenging seasonal category for everyone.
Interesting. Okay, shifting gears to operations. How did they manage costs? SG&A.
SG&A was actually down 1% year over year. That's despite those big marketing investments we just talked about.
So cost savings elsewhere must have offset the ad spend.
Exactly. They mentioned ongoing expense management, restructuring efforts paying off.
And inventory. Always a key metric for retailers.
Inventory ended Q2 at $718 million. Now that's up 8% in dollar terms versus last year and up 3% in units.
Okay, up a bit. Are they worried?
And they said they're comfortable. They explained the cost increase is mainly due to tariffs, which makes sense. It costs more to bring goods in.
Right.
And they stress the inventory is well positioned, especially with things like jeans, long life items, not stuff they'll need to heavily discount immediately. Fits the strategy.
Makes sense. What about capital allocation? Buybacks, dividends, stores?
They've been returning cash to shareholders,
Good.
$131 million year to date through buybacks. That includes finishing a $200 million accelerated share repurchase program.
Okay, the ASR, that reduces the share count pretty quickly.
Right. They said it cut diluted shares by about 10%. Plus, they paid the regular quarterly dividend, 0.125 cents per share in Q2.
And investing back in the business. CapEx. Stores.
CapEx for the year is pegged around $275 million. A lot of that is going into optimizing the store fleet.
What does that look like?
They plan to open about 30 Aerie and offline locations, continuing that growth story. Remodel 40 to 50 AE stores.
And closures.
And about 35 to 40 American Eagle locations by the end of the year. It's about rebalancing, making sure the physical footprint makes sense financially.
Right-sizing the AE footprint while growing Aerie offline. Seems logical.
Mm-hmm.
Okay, let's zoom out to the investor context. The market loved the results, huge stock pop. But what about those bigger picture headwinds? Tariffs keep coming up.
Yeah, tariffs are definitely still a thing. They gave specific numbers for the impact, expected to hit Q3 for about $20 million.
Gosh.
And Q4 for maybe $40 to $50 million. So there's a real cost pressure. And it's why they guided gross margin down year over year for the second half.
So what are they doing about it, besides just absorbing the cost?
They have a multi-pronged strategy. Big one is shifting manufacturing, reducing reliance on China and Vietnam.
Diversifying suppliers.
Exactly. Also negotiating costs with their existing vendors, optimizing freight, using ocean shipping instead of more expensive air freight where possible.
Makes sense.
And they mentioned selective price increases, but said that's a smaller piece of the puzzle, mostly supply chain and negotiation.
Are these efforts making a dent long term?
Seems like it. They gave a projection for fiscal 26. The unmitigated tariff impact then might be around $125 to $150 million.
Okay.
Which is down from the $180 million unmitigated hit this year, fiscal 25. So yeah, they're making progress in reducing that exposure over time.
Good to see they have a plan. So with that context, what does the rest of the year look like according to their reinstated guidance?
Okay, for consolidated comps, they expect them to be up low single digits in Q3 and Q4.
Okay, positive comps in the back half.
Right, which would bring the full year to roughly flat comps overall. And they actually gave a Q3 to date update, said comps were already running in the mid-single digits.
Oh, that's strong. A good start to Q3.
Very good start. For operating income, they guided Q3 to $9,500 million. Q4, $130 million.
And the full year?
Full year adjusted operating income guidance is $255 million to $265 million.
Okay. And SG&A costs, still investing in marketing.
Yep. SG&A is expected to be up high single digits in Q3, mainly because of that ongoing ad spend.
Right, funding the Kelce and Sweeney campaigns.
Exactly. But then they expect SG&A to be flat to slightly down in Q4. Long term, they want to leverage SG&A, meaning have it grow slower than revenue on a 3-5% total revenue growth model.
Aligning spending with growth. Okay.
Yeah.
So it feels like management's credibility got a big boost here, right? Going from pulling guidance to this confident reinstatement and strong Q2.
That's a huge swing in sentiment.
What are the key things you'll be watching now to see if this momentum continues?
Well, definitely watching if they can protect those gross margins despite the tariffs. That's crucial.
Yeah.
And maybe even more important, can they actually convert those 700,000 new customers into repeat buyers? Is the buzz really turning into sustainable business? That's the big test.
That customer loyalty piece is key. All right, before we wrap up, it's time for our This Is Not Financial Advice segment.
Our favorite disclaimer part.
Yes, and let me just say it loud and clear. This is purely for discussion, folks. Just some ideas. Always, always talk to a licensed financial professional before making any investment decisions. Seriously, this is not financial advice.
Couldn't have said it better myself.
Mm-hmm.
Okay, so with that firmly in mind,
Yeah.
what's the idea this time?
Given everything we've discussed, the big Q2 beat, the guidance back, the marketing success driving real customer numbers, we're thinking about a bullish pairs trade.
Ooh, okay. A pairs trade. What's the setup?
The idea is go long AEO common stock.
Okay, betting on the turnaround story continuing.
Exactly. The argument is they've shown operational improvement, cost management, they have a plan for tariffs, and maybe the market hasn't fully priced in the potential of converting all those new customers long term, especially with more campaign elements coming.
Right. The initial pop was big, but maybe there's more room if they execute well. So that's the long side. What's the short?
To hedge against just general retail funkiness or macro worries, you'd simultaneously short a diversified retail ETF, something like XRT.
Ah, okay. So you're betting AEO outperforms the broader retail sector.
That's the core idea. AEO has these company-specific catalysts, the marketing, the Aerie strength, the operational fixes that might let it swim upstream, even if the overall retail environment is choppy because of, consumer spending worries or whatever else.
So you isolate AEO's potential outperformance relative to its peers while hedging some of the general market risk.
Precisely. Capitalizing on their internal momentum while acknowledging the external challenges facing the whole sector. It's a bet that their specific strategies will make them stand out. Purely theoretical, of course.
Of course. A very interesting thought experiment.
Definitely one to ponder. Okay, so let's recap this deep dive. American Eagle Outfitters, AEO, really made a statement with Q2.
Big time. Huge beat on earnings, revenue beat, guidance reinstated.
Plus, those Sydney Sweeney and Travis Kelce campaigns seem to be genuine game changers, driving massive customer acquisition.
Yeah, and they're showing operational discipline, tackling tariffs head on, returning cash to shareholders. It's a pretty compelling turnaround narrative right now.
So the final thought for you, our listeners, think about that customer acquisition piece. Can AEO really turn all that buzz, all those new faces, into loyal shoppers?
Can they make that buzz into business stick long term, even with things like tariffs swirling around? That feels like the critical question for AEO's future.
Something to definitely mull over. Thank you so much for joining us on Talk Tickers for this deep dive into AEO.
Hope you found it insightful.
We'll catch you next time for another critical earnings call breakdown.